thank you very much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour, the final stretch of 2025. Whether stocks can stage a rally into the new year, we will, of course, debate the road ahead for your money with the investment committee. Joining me for the hour, Jenny Harrington, Steve Weiss, Jim Leventhal, Josh Brown. Check the markets. We're green on this Friday. Have expiration today, so could be interesting into the close, which will follow, obviously, on closing bell a little bit later. The headlines today, I think, really, Bitcoin's rebounding, so that's helping risk-on sentiment. Tech is mostly higher. That's helping risk-on sentiment. And, Jenny, at the same time, Bank of America's Michael Hartnett today says we have a contrarian sell signal for risk, that the bull-bear indicator has gone from 7.9 to 8.5, triggering a contrarian sell for risk. What do you think?
I think he's probably right. So the Bitcoin rebound today seems very unreliable to me. I thought yesterday was so interesting how up until about noon or maybe a little earlier than that, it rallied up to 89,000 and then faded hard in the afternoon down to 85,000. So it's kind of a chicken and an egg. Like, I don't know which is begetting which. Is it the risk-on trade from Bitcoin that then trickles into tech? Is it the other way around? I'm not sure, but they seem unreliable. And I think it's been an interesting and indicative past couple weeks where the market seems kind of desperate to rotate. So on the big down days, I've seen portfolios like what I manage where it's value or dividend, or more small cap oriented. I've seen those really, really outperform on the big down days. And I don't know how else to express it other than it just seems like the market's desperate to rotate. It's looking for an excuse to rotate. So that sell feels right to me.
I mean, the problem with the sell signal, Weiss, is that since 1928, the S&P has risen 75% of the time in the last 2 weeks of December, rising 1.3% on average. And then, yes, okay, so this is Michael Hartnett at Bank of America, while at the same time, the Bank of America Flow Show says you just had U.S. stocks $77.9 billion inflow, the second biggest ever.
Yeah, so here's how I look at it. All those data points are useful, particularly when they come from credible people like Michael Hartnett. But for what I do, for what everybody else does, they're just noise and just like a sign along the roadway.
There's always noise. You guys, people like you have to cut through it, though.
Exactly.
Right?
And so look, I like hearing it because I'm a junkie for all the information. But what am I going to do? What am I going to do with that? I'm not going to sell anything, particularly since he's not calling for a crash. And even if he were, I still wouldn't sell things because the probability low. So the point of it is, if that does happen, and I've got some cash, and it's worse than he says, because while the market is just about at its old highs, the stocks I'm involved in are still have suffered meaningful losses relative to the highs.
Do you feel like, I mean, when you could take a contrarian indicator, or you can take history, which is on your side, right, according to this data, and then you could look at the overall trend, which still feels like it's positive, and maybe that's what's most reflected in the fact that you have a near $78 billion inflow, the second biggest ever, into U.S. stocks, and you have the biggest outflow from cash since April. That tells you, so don't follow the commentary, follow the flow. Follow the money, right?
Look, exactly. The interesting thing is, for everybody that says bull case, you can find people that are saying a bear case. For every person that says don't buy here, others will say, buy. So what I tend to look at is exactly what you say. What are the longer-term trends? What are the tailwinds or headwinds? And I come up with tailwinds of a very dovish Fed head that's going to come in, right, in May. And I come in right now with, we're close to a neutral policy, and all the forecasts are for the economy to gain some strength. Now, I am cautious because you see, and here's the most interesting thing in the market that I've seen in such a long time, I'm hard-pressed to see when it was more interesting, is that you've got this battle between AI and the job losses it's going to create versus AI and the productivity that it's going to create. And we're seeing that already. So the Fed's never dealt with that. They've admitted it's confusing to them. It's definitely confusing to me. But on balance, I think it's very positive. But you've got to be in absolutely the right sectors, the right stocks.
Farmer Jim.
Your Honor.
You go out in the field, you say, which way is the wind blowing to this market?
Yeah, that's a good analogy.
And what do you think?
I think we've been through a little squall here. I don't think we've been through a major storm, but we're all talking right now about sentiment. And there is a sentiment shift today. It's just clear. You can see it in the NASDAQ outperforming the RSP. You can see it in Oracle and CoreWeave, which I know we want to get to Oracle in just a little bit, but it's an indicator. Oracle has been the sentiment indicator for the last several weeks. Yesterday we had that Michigan data center delay, or whatever you want to call it, announcement. The stock got mauled. Today we get the TikTok announcement and it's up. Now here's the thing about sentiment. For all of us on the desk, we're basically fundamental analysts. That's what we believe in for the long term. But we like when the sentiment turns like this. The question is, will it last? And whether it will last or not, I take comfort from what you started with, Scott, which is where we are in terms of seasonality. Last 2 weeks of the year, I'm not so big on calendar things, but it is a fact that when you have a strong year like we've had and you get to the final 2 weeks, people want in. That's just what I've seen with decades of experience, that you're likely to get this sentiment crescendoing into year end.
Josh, what's your read here?
I mean, I'm not an I told you so guy, and I get lots wrong too, but we had this conversation last week. I told you the most obvious trade is the one that's going to work, and it's the most frustrating for people that are always looking for an inflection point or a turning point or a contrarian, whatever. Like they're buying the biggest, most liquid stocks. And why are they doing that? Well, A, there's muscle memory, and you take home the date you brung to the dance. So there's some aspect of that. Two, if you've been trailing the index, probably a large reason why is you've been underweight some or most of these names. So it's a very obvious way to clean up your window dressing. And then three, this is where the earnings growth is going to be next year. Still, can't believe it, but still, the preponderance of the earnings growth for next year is in large cap tech. Like, I'm sorry that that's the case, but that's the case. Plus, a lot of these stocks went on sale. We talked about Meta, Oracle, which is not officially Mag 7, but whatever. So now you got Tesla at record highs. You got Alphabet close enough. Apple's had a great year. Microsoft went green today. Nvidia back to 180, like 170 was just a bad dream. And it's like all over again. Oh, man, look what they're doing. Mag 7 rip into year end. Oh, my God, I can't believe I fell for it again. I really thought this was going to be the time that those stocks didn't get bought. Come on. This to me, this was very easy, very obvious. We talked about it last week. It didn't take long.
Well, I think it follows what we were talking about. If you look at the flows, you follow the money, you follow the earnings. I think Josh is absolutely right. The best earnings growth is still within the mega caps. AI ain't going anywhere. People are going to still chase that as long as they think we're still in the second, third, or whatever inning. Dan Ives is out with his top 10 predictions for tech in the new year. I should let you know he's going to be on Closing Bell with me today. We'll go through his predictions later this afternoon, but at least the headline is that tech stocks are going to be up 20% in 2026. Think about that.
So Josh is right from the perspective of earnings drive price appreciation, and he's also right that next year, for the full year, technology is going to be probably the leader in earnings growth. But here's an interesting side note to that. If you break next year's predictions into first half versus second half, in the second half of the year, it's the other stocks, it's the non-tech, the 493 really, that are projected for now to outgrow earnings compared to the Mag 7.
Why?
Will that happen?
Why?
Because of the broadening, everything that we're talking
AI
about,
adoption.
what AI adoption, productivity, the continued build out of data centers, which flows through to industrials, financials, deregulation of financials, the one big beautiful bill. There's a lot of reasons why, but here the pushback, if there is pushback, is that this has been the projection for the last year or so, and it hasn't come to fruition. I do think, though, based on the reasons I just said, that when you look at the second half of next year, you will see better earnings growth from the other 493, and I would expect that to start to be anticipated in a broadening rally in the first quarter of next year. Not the next 2 weeks, first quarter of next year.
Yeah, another thing when we think about tech growth, tech earnings growth for next year, is the numbers are still there, but as compared to 2025, they all fade. So you've got Microsoft, who should grow earnings this year at about 20%. only 14% expected next year. You can just go down the list. Google grew earnings 32%
Well, yes,
this year.
the
I'm just
comps
saying,
are going to be
they're
a
going to
little bit
fade.
hard.
They're going to fade.
They're going to fade from,
relative to last year. So you're going to have
yes, but they're still better than relatively everything else.
maybe.
It's
Right?
still
Maybe.
predictable. It's still predictable growth.
I'm just saying, you've
It's
got
still
two
fortress
things.
balance
Yes, it's
sheet.
still
like-
predictable, right? Isn't that part of what you guys
Yeah,
try and do?
but, like, let's
it's
just
the
take-
most predictable growth in what still remains an uncertain environment.
Fine,
so
but
you
you know
go
what?
with where the best predictability
And
is.
here's what can
Maybe.
accelerate that growth. What can accelerate the growth is that analysts are only focused on existing products and existing operations at Meta and all the others. But AI gives them the ability to fast track new products
Right.
and new revenue streams into their shares. And that goes from Microsoft, it goes to all of them. So I think the earnings growth for Microsoft in particular, given what's going to happen with cloud, is understated, as well as the upgrade now to new Windows platforms.
But I want to get back to the predictability, like being a really big positive, because what we've seen in the last few years is actually when a company comes out and meets their earnings expectations, it's kind of a snore. I mean, look at Nvidia, unbelievable earnings growth, and the stock snores after earnings. What the market seems to like is surprises. I think there's more room for surprises in the 493 than there are in the Mag 7 next year.
I'm okay with a yawn on earnings, particularly Nvidia.
Agree. I'm just saying.
Because it's so
argues for products.
pre-advertised. By the time the report's okay, hey, so what? We all expected that. And actually, it trades down typically after a quarter, not every quarter, because the whisper numbers keep feeding on themselves. But you know what? I don't mind the step function stocks moving higher.
I love how we're yawning at Nvidia up 34%.
Stacey Rascon is not yawning. Stacey Rascon is not yawning at
Strong.
Nvidia today. He believes it's set up well for the new year. He said we'd be buyers. 25 times PE may not seem particularly cheap for your ordinary stock, but this is Nvidia. Over the last 10 years, there have only been 13 days where Nvidia stock traded cheaper relative to the stocks than it is trading now. Investors buying Nvidia stock at current levels have historically done very well.
Here's the issue with Nvidia, though. It's not an issue with the fundamentals at all. It's an issue with continued movement in the share price. Everybody's bullish on Nvidia. Maybe you find the isolated person wants to make a name by saying the fundamentals are going to atrophy. So where's the marginal buyer to come in and drive it much higher? And that's where I struggle. So I still own it. I've said it's not one of my larger positions. I wish it had been, but it's not. But I think it's going to be fine. It's a permanent compounder. But make no mistake about it, as we see, there is competition on the horizon and actually readily available right now, competition for some.
Josh, what about Rascon, the case he makes that you could buy it here?
Yeah, and I listened to Dan Ives saying much the same thing. Like the negative on Nvidia, or the thing that gave people pause, was this idea that we're going to take application-specific integrated circuits like TPUs, substitute them at data centers for both training and inference, and all of a sudden there would be a more cost-effective way to avoid buying Blackwells and then buying the next chip next year. I'd have to see it to believe it. So far, it doesn't appear to be coming true. The backlog here for Nvidia is as strong as it's ever been. And, I get that people were looking for a bear case on Nvidia, and every one of them kept falling apart. First, they said CoreWeave is a Ponzi. Then they said, the stock would be unloaded because the earnings would disappoint, and that didn't happen. So it's like one bear case after another, and Nvidia somehow just continues to find a way to defeat those bear cases with its actual results. And I wouldn't be shocked if we stopped talking about this new bear case when we're in Q1 and they tell you the backlog is even healthier than ever.
Maybe it's tired talking about Nvidia, period. Maybe we should be spending more time talking about an Amazon, for example, which year to date is not even up 4%. But you've got Scott Devitt of Wedbush today making it his top internet pick, certainly one of them. And you have Citi listing it among their top internet picks. Maybe it's time to focus on What's going on there? Where can you make the most upside in 26?
Well,
not sitting here back and forth debating Nvidia, which everybody knows is in what appears to be a sweet spot. People are questioning whether Amazon is.
Yeah. So let me tackle Amazon very quickly, and then we'll hear what the rest of the desk thinks. In my opinion, the chart is in no man's land. This is not technical, just purely on fundamentals. Everyone that is not an Amazon should be giving it a second look. And I know it's been an underperformer this year. It's now selling at a trailing 32 times price earnings multiple. This is one of the 5 most dominant companies in the entire world. And a forward P of 29 times with 11% earnings per share growth expected next year. So not cheap, but historically cheap relative to its own multiple. The last earnings report, they told you 10 to 13% in sales growth, which means they'll probably do better than that. But that would take you somewhere between 206 billion, 213 billion for this quarter that we're in right now. Has not been outrageous on the capex front, although it is a high capex company. That's not new for Amazon. They've always been that way pre-AI and during. And the last thing I would say is the stock has just put in 3 consecutive higher lows. It has not been able to break out above 238, but one day it will. And do you really want to be watching from the sidelines when that happens? I don't think so. If you've got PTSD from watching Alphabet do that, as I do, from the sidelines, you probably don't want to see that repeat. This is the dominant cloud player in the world, and Anthropic's version of AI, which Amazon is heavily tethered to, is the leading enterprise version of AI for the corporate space. And I think the stock could work.
Weiss, you own it too.
I do, and I agree with that. Of course, it's been a disappointing year in terms of performance, but again, step function of performance doesn't bother me. Now, the challenge they have is they deal with the consumer. It's a big part of their business. It funds their other investments, as does cloud.
Okay,
Cloud
yeah.
is the most profitable.
Consumer's been hanging in there.
Right. So I think it's a wait and see, but
why? I'm wondering, why is it such a wait and see? Right? They got their part of Anthropic, right? AWS.
Everyone's going to love it.
It's a wait. Okay, I can tell you why.
They're going to love it.
It's a wait and see because it's only 11% earnings growth next year and is trading at almost 30 times versus something like Meta, which trades at 22 times and has 21%, versus Apple. No, forget Apple. Sorry, that was a bad one. Versus Google, right, which has accelerating earnings growth after this year and trades cheaper. So I think it's a wait and see because the combination of valuation and earnings growth is less compelling than some of the other mag companies.
It's a momentum market. So the other stocks are always the hotter stocks. They've moved a lot. So you get on board, and when you got on board with Amazon, it just didn't do that well. I think the fundamentals will prove out. But the biggest risk actually to this market, to me, is OpenAI. Because OpenAI, they're going to raise $100 billion. I don't know how they get there. Typically in these
$830 billion right. It would take the valuation to if they did that.
Yeah, which what's typically happened in these raises, we've never seen one this size, by the way, is that you have an insider who's in at a low level and continues to add, and they lead the rounds and set the valuation. And guess what? Then they get an incredible mark on their holding that they can go out and market to investors for a new fund. I think that's extremely problematic.
I'll put the stake in the ground that I think 2026 Amazon is going to do what Google did this year and what Apple's done since May. All right, that stake's in the ground. And I don't care about the numbers and the valuation right now. There's no company like this that has as many pistons in its engine as this. Whether it's AWS, whether it's the Trainium chips, whether it's investments in OpenAI, whether it's the retail business, whether it's the logistics business, which we never talk about, but they created this from whole cloth, and it's basically putting FedEx and UPS in the hurt locker. What else are they going to create?
That's not entirely true.
It's true enough that give me a little artistic license. Give me a little artistic license.
I'll give you that.
And what are they going to create next? There is no company that is as diverse as this. If they run into a pothole somewhere, the other 4 pistons or 5 pistons are going to pull this engine through.
I mean, stock's making a little nice move here. I like
it. I'm not negative. I like it.
Well, you own it. I mean, if you didn't like it, you wouldn't.
Exactly.
Presumably, you wouldn't own it.
Next to Jim.
How about this? How about I'd rather own Nvidia than Amazon? Maybe that's why. right? Better multiple, better earnings. I know. How about that?
Yeah, and you don't.
I don't know because I can't because we have these super strict, disciplines around our strategy.
You still would rather own Meta than Amazon?
Totally.
Absolutely,
and again,
me
this
too.
I know Jim says he doesn't care about the numbers, but like I do care about the
Well, I think
numbers.
the numbers are fine.
Okay, but you've got Meta 22 times 21% earnings growth in 26. You've got Nvidia 24 times 60% earnings growth in 26. You've got Amazon 29 times 11%. Like that just doesn't look as good.
Right.
My
And Jimmy,
Meta
I hear
position
your
is twice as
argument.
big as my Amazon position.
Oh, interesting. Jimmy, I hear your argument on the diversification, but that can cut both ways too. That
I mean,
can
sure,
cut,
if we get a
like,
recession,
is it
then, if we get a
diversification or
recession,
is it
then all those
diversification
businesses are going to
of the
come
business?
down. I'll
Let's do
grant
this.
you that.
I mean, Amazon, because it's takes this discretionary stock
Yeah.
in the group. Let's just hit Nike because it's a drag for certain today.
Yeah.
I mean, that's what the market is saying. After China is a problem. Obviously, stock's down 10%. There's no direct ownership on the desk. You've got On Holdings, which you continue to believe in. As there's a competitor that people are citing as one of the problems with a Nike is market share being taken by the Ons.
I think Nike is quite a bit bigger in the scope of businesses than On is.
Well,
but
you think?
No, I know. But clearly On, within the footwear and slightly in the apparel business, is killing it versus Nike. I don't really know what to say about Nike. I sold this 2 years ago. It was literally twice what it is now. It's not a pat on the back. It's that I really can't believe they haven't been able to fix this company. It is a brand that is up there, in my opinion, with an Apple, with a JP Morgan, with any of the legends of brands, but they seem to have lost their way. So has Lululemon. And I think the ultimate takeaway is in retail, you have to choose who the winners and the losers are.
Brands, with the exception of Apple, have a limited lifespan. Sometimes it's 3 years, sometimes it's 10, sometimes it's 20, because then competition comes in the market. If you walk into any retailer, and there aren't a lot of them, like a Dick's Sporting Goods, for example, you'll see more and more shelf space that was Nike with On.
That chart is nuts right there, okay?
Because it's so...
That chart is nuts. 5 years.
nuts.
Do you know?
If you look from late 21 to 22, I don't know. Hold on, I'll come to you in a second. But if you asked people in late 21 or early 22 when the stock was up where it was, could you ever imagine a period where Nike trades as low as it is now?
Nope.
That's an ugly-looking chart, Josh.
This stock, since it came public in the early 80s, and most stocks of this size have never had 4 consecutive down years, and we're working on the 5th right now. I mean, we're almost in the books. Like, it's just it's really historic, the degree to which they've destroyed this company, and I think that it's unfixable. I just feel like there's 10 other turnaround stories worth talking about that have easier answers. Chipotle, Lulu, Starbucks, like all relatively as big in terms of being like great brands, just more obvious fixes. The amount of things that have gone wrong here and are as yet unaddressed, and now you've got this bigger problem where the new stars in the NBA just do not sell shoes. Like they're trying really hard with a couple of guys, but like in reality, you need somebody that drives kids to want to buy the next shoe and the next shoe. And LeBron is almost 40 years old, and KD is almost on his way out, and they don't have that next gen. They thought it would be Ja. Ja's got some issues off the court. Like they're missing that next star. Does Wembanyama sell Nikes next year? Like,
right.
I don't know what you do about that. Honestly, I don't know what Nike
the
could
other
do.
issue, it seems to the biggest issue I would surmise is that, they didn't have enough innovation outside of whatever was happening with Jordans and Dunks.
Yeah.
That if you weren't buying those because the other things weren't innovating and there weren't compelling new products, On and Hoka and whomever else stole that market share there. So obviously the Jordan business is still strong. But if you're not buying a pair of Jordans and you're not buying a pair of Dunks, are you buying the On or the Hoka instead of whatever the comparable level of the Nike is?
Right, and
they haven't been able to get out of that tornado.
Exactly. So that
whirlpool of that.
But they can't.
That chart defines complacency, and it's been repeated for year after year that they lack the technological innovation to drive the brand into a different market, meaning different market, younger markets. So.
See,
again, complacency.
I don't think it's complacency. I think it goes to like business school 101, where you're forced to read Michael Porter's competitive strategy, and he's like, there's 5 forces, right? It's rivalry, new entrants, substitutes. So when we think about Jim's argument, and he says this is a brand that was on par with JP Morgan and Apple, it's not, because anyone can compete in the sneaker space. Anyone can compete in the athleisure space. Those areas are easy. There's very low competitive barriers.
No, it's not easy.
It is easy.
No,
it is.
No, it isn't.
Go on the
No, it isn't.
Real and see
It's
how
not.
many fashion brands
It's not.
there are. How many guys?
You should ask.
How many
Look
big
at
banks
Under
are there?
Armour's chart. And then come back
It's my
and tell
point
me.
exactly.
No, it's
not. It was
not,
so easy
because,
to fire.
No, it wasn't easy.
You can't fire up
wasn't
another
easy.
JP Morgan. You can't easily fire up
Under
another
Armour
Apple.
learned how difficult
How
it
hard is
actually
it?
was to compete with Nike,
That's the
especially in
whole point.
footwear.
That's the whole point. And then
easy.
everyone else floods it.
Jenny,
Vuori's new.
There's
Lulu's
nothing easy
new.
about building
Aloe's
a
new.
multi-billion-dollar brand.
I'm
There's
telling you,
just not.
it's easier to build a
Plenty of people have
multi-billion-dollar.
tried.
It's easier to build a multi-billion-dollar athleisure retail sneaker brand than it is to build another bank
Go do
or another
it. It's
Apple.
that easy. Go do it.
I don't want to, but I'm going to tell you,
You don't
something.
want billions
and
of dollars?
everyone who's watching can tell me this too. How easy is it to go change from JP Morgan, your Chase account, if you're annoyed at your people there, over to Citi? It is a pain in the neck. How easy is it to get rid of your cell phone?
Hold on.
How easy is it to get rid of your Apple
It's
cell phone
easier
and
to
switch to
build a
Samsung?
multi-billion-dollar
No, but you know what? I want to wear Hoka's this year instead of Nikes. Easy switch.
Make it quick, Josh, because I do have to take a break.
Okay,
For a
Jenny,
variety
this
of
was
reasons.
suicide. Jenny,
What are you
this
talking
was
about? It's
suicide.
the easiest
They
argument I
told-
made all year.
Please. They told Dick's and Foot Locker, we don't need you anymore. We're going direct to consumer. That created a vacuum. What did they think Foot Locker was going to do? Nothing. They filled it with On.
Guys,
They filled it with. It's not easy. Nike
It is
handed
easy.
it to them.
How many sneaker brands are there? How many cell phone brands are there? How many sneaker brands are there? How many big banks are there? That's the answer. It's easier to compete in sneakers than it is in larger retail brands, like larger brands like Apple.
I'm glad I
and
could
JP
stir
Morgan.
this pot today.
All right, we're
fun.
taking a break. Coming up next, Uber and Lyft are hitting the skids this week. The AV wars, the autonomous vehicle wars, are heating up. So buckle up, because we're going to debate it next.
Cities. Tesla is in 2 U.S. cities, and Zoox is in 2 U.S. cities. That's where they're operating right now. We're not talking about future plans. There are a number of cities that are going to be added. Waymo is a good example. Next year in the United States, they plan to add 11 cities where they will be testing Waymo vehicles. And if they are successful, if they like the results that they're seeing, maybe they will be part of the Waymo network by the end of 2026. They're also testing in Tokyo and New York City, 2 very densely populated cities. That will be interesting to see how those tests go. As for Tesla and the robotaxi, they're testing driverless taxis, robotaxis, I should say, in Austin. That was the post from Elon Musk. And he says that the robotaxi fleet is doubling in Austin. But keep in mind, it's not near the 500 cars that they initially said. Remember, not too long ago, Elon Musk was like, yeah, we're going to have 500 in Austin by the end of the year. No, that's not. They're not going to be there by the end of this week. As you take a look at shares of Tesla versus Alphabet, the parent, obviously, of Waymo, the robotaxi app downloads, 2790 per day. That's the most recent data. Came out about a week and a half ago. You compare that with the number of downloads for the Waymo app, specifically for the app, not talking about Uber, it was 24,831. So Waymo is clearly well ahead, Scott. And one last thing, I'm glad you have Josh there today, because I've heard Josh say this a number of times about the future and how people will be calling for ride shares, autonomous ride shares maybe. I was in California last week. Every person that I've talked with out there who had both the Waymo app as well as the Uber app, I said to them, do you specifically go to Waymo or do you go to Uber? And they almost all said the same thing. Who's closest? That's really the bottom line. And I've heard Josh say that time and again. Convenience will be what ultimately matters here. And maybe price plays into it at some point when there's enough scale there. But everybody said the same thing. Who's the easiest to get to can get to me as quick as possible.
Stay with me then, Phil, because I'll throw it to Josh for his response to that.
Yeah, so for me, this feels really obvious. I'm a power user. of autonomous rides. I am a man about town, and I honestly don't care. As long as the car is clean, it shows up quickly, and I can get in and get out and get on with my day. I understand that people land in a city like Austin and they get really excited because a robo-taxi pulls up and they say, oh, I want to try that. Of course, I want to try it too. And I have. And the novelty will wear off because eventually it's going to be interchangeable, human or autonomous. What's the best value? What's the fastest ride, the most convenient? And on that score, this is going to be a commodity business. Google is spending, Waymo is spending $150,000 on these Jaguars each. Do you know how many autonomous taxi rides they need to have going per day, per vehicle, to ever see a profit? So they will scale, they have to, and that's actually great news because all of these services will have autonomous. The most expensive part of the ride is the driver take rate. Removing that from the equation worldwide is going to make ride hailing a much better service for the consumer. But just remember, you got to clean the cars. If the driver doesn't own it, somebody's got to do fleet management. You have to, yeah, you have to, right? If I get into the car before Phil LeBeau and I take my ice cream cone and I plant it head down on the back seat and I get out of the car, what's his rider experience like when I'm done? Okay, so let's just all remember, it's not going to be a glamorous business to own these things. I think eventually the fleets will be owned by private equity.
Phil, last word.
Just to play off of what Josh was saying, I was talking with somebody at the hotel restaurant, and they had just come in to Palo Alto, and they wanted to see what it was like to maybe get in a Waymo. They downloaded the app, and they looked, and then the closest Waymo to take them where they wanted to go, 22 minutes away. And they were like, I don't need that. So that speaks to it. And I'm not saying that that's the experience for everybody with Waymo, and I'm not denigrating the Waymo service. What it does speak to is what Josh has talked about. It's convenience and it's price. And it's not sexy and it's not glamorous, but that's really what ultimately will drive this business.
All right. Hotel restaurant, Phil, or the hotel bar, maybe?
On the expense report, it said restaurant.
Good answer.
Great answer, Phil. We're back. DraftKings, just the latest company now to get into the prediction markets, releasing a new app today called DraftKings Predictions. CEO Jason Robbins, by the way, coming up next hour. It's a CNBC exclusive interview. And you don't want to miss that. It was Coinbase yesterday. Guys, I thought Gillian Tett of the Financial Times had an interesting column today on this very topic, where she says, she writes, quote, call this the casino mentality of 2025. Or to put it another way, our modern age is no longer just being shaped by the 3 Ps of populism, protectionism, and extreme patriotism. There's another P, namely prediction mania as well. What do you make of what's happening in these markets? Every day it's another announcement on word that the prediction markets could hit $1 trillion in trading volume by the end of this decade.
Yeah, so look, when you continue, new players continue to launch in the markets, the argument is generally made that expands the market because you've got so much prevalence of these players out there. I just personally don't think the market is that big. And I think we'll see similar result as we saw with the DraftKings and the others, where it's going to be a commoditized market where they're not going to make much money off of it, and it's going to help a Robinhood because they've got a broad offering. It's going to not really help the DraftKings that much. So that's my view on it. I don't
know. I wonder, what...
I doubt the $1 trillion number is my point. I think it's way lower.
I'm with Steve on that. I'm with Steve on that. This is like the
more.
cannabis stocks. This is like the cannabis stocks. Everybody was like, oh my God, they're going to legalize it. It's going to be bigger than alcohol. Those stocks, every one of them is down 95%. I don't even think there's one that's left that's not a penny stock. The ones that are still trading, I don't even know if there's one left that even would qualify it for the Russell 2000. I'm not sure. What was the biggest one? Tilray? It turns out, yes, it's a market. People smoke weed. It's just not that profitable to be in that business. So I am sure there will be a lot of people taking these prediction market bets. Most of them, the more they play, will lose money. This is not the same as investing in the stock market. If I buy a stock and I'm wrong in the first 3 weeks of buying it, it doesn't go to zero. I have to hold it for longer. It's a trade becomes an investment. If you're wrong on a prediction, it's zero. Go next.
Yep.
Like,
I just don't think
how
people
much of an
spend time on it.
appetite do we really think there is for that?
And actually, I believe, now stay still for a second, it'll be easier to create a predictions market than to build a shoe company.
I agree. Because you can just do it online. You can just ask your AI programming bots just to fire it up.
Yeah.
It's a low competitive barrier
Yeah.
to entry.
Well, it's hugely popular.
Low.
we know that. And everybody obviously is trying to get into it, as we see almost every day. Up next, our top calls of the day, a big target hike for this year's best performing Dow stock. Halftime's right back. It deserves it. Stocks had a great year. It's up 63%, another 52-week high today.
Yeah, thanks, Scott. And, you know, there's specific reasons why it's done so well. It has right-sized the company. It has leaned into high-growth areas like investment banking, wealth management, and it's controlled costs. Now, just this week, we're getting a new piece of news about what I think will propel the stock even higher from here, which is getting out of trouble with the regulators. There are a number of consent orders and other regulatory hangovers that are on this stock. And just this week, the OCC, Office of the Comptroller of the Currency, lifted an amendment on one of their consent orders. Now, the consent order is still in place. This is a small move, but it indicates that in the coming year, I think there will be a lot more regulatory relief based on the company's continuing efforts to do better. And that will move the stock higher.
All right. Josh, what's your final trade?
Nice rally in Live Nation since Thanksgiving. I think it continues.
Okay. Farmer Jim.
Disney. There's been this strange, almost inexplicable momentum over the last month. Maybe the Bob Iger succession announcement is coming soon.
Oh, okay. Mr. Weiss.
Baba, it's very cheap. There should be a discount for China, but it still has the best and the most complete story there 17 times next year.
Okay, but you bought it, right?
I own it. I added to it today.
Okay. Well,
Sorry.
you
Thanks,
bury the lead.
Thanks for the prompt. Thanks for the prompt, Scott.
I got to do everything for this guy.
Yes.
Jenny, what do you got?
Amcor, the latest addition to our equity income strategy, 9 times earnings, mid-teens earnings growth ahead, 6.25 yield.
All right, good stuff. Thanks, everybody. Good weekend, all. I'll see you on the closing bell. The exchange begins right now. Well, thanks so much. Welcome. Closing bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make or break hour begins with the road ahead for stocks, which, though higher today, have been sputtering a bit as the year winds to a close. We'll ask our experts over this final stretch what 2026 might hold. Let's show you the scorecard here with 60 to go in regulation. Green arrows, as you see across the board today. Bitcoin's bouncing. That's been a positive sign for risk sentiment today. So is tech. It's higher. Most of the mega caps are rising, so overall you have definitely more of a risk-on tone today. Nike, though, a big drag following its earnings. Caterpillar, it's topping the Dow this year and getting another price target raise today. That stock's up another 2%. And how about DraftKings, the latest to join the prediction markets craze, as you were just hearing on Power Lunch. Yet another company in the ring, and the stock's on the move. It does take us to our talk of the tape, where the biggest money in the market is positioning for 2026. Let's ask Tony Pasquarello. He is head of hedge fund client coverage at Goldman Sachs. He's back with us at Post 9. It's good to see you. Welcome back.
Thanks, Scott.
Nice to catch up with you before we get out of here for 2025. You know, there's something to be said for seeing a durable trend, not making things too complicated, and staying with the story for a considerable period of time. I just described you, because your point of view and your perspective on this market, from the notes that I have read consistently and mentioned many on the air, it hasn't changed. And you are, as you say, responsibly bullish, and that hasn't changed. Is that fair?
I'll take it. Yeah, I think you just set me up for a giant jinx, maybe a sell-off. but I'll kindly take it. I would say this. I think the big dynamics in the game are still favorable for risk. We think the Fed will continue to provision more liquidity as we have this cyclical upswing in the economy. We've got S&P earnings up 12% next year, following plus 11% this year. And so I do think that interplay between the Fed and the trajectory of the economy alongside this earnings growth is affirmative of a bull market and a primary trend that's still higher.
You haven't been tempted, I guess is the word to use, by the broadening story peeling you away from what's gotten you to the dance this far. And it doesn't sound to me, from looking at your notes and your outlook, that you expect anything different in the new year. Stay big. Don't get caught up on the idea that small caps are going to have some epiphany in the new year. and have a tremendous year at the expense of what's going to happen with the large cap stocks. Fair?
Still a believer U.S. mega cap tech will do as well or better than any other part of the market. I think some of the recent broadening you've seen, where some of the burden of leadership has shifted from the AI names and mega cap tech to large cap cyclicals, I think that's a good thing. And it's consistent with our view that the economy is going to pick up a bit of speed.
So that's durable then, potentially.
I think that is durable. So again, 2.5% GDP growth, moving up from 2% this year. So you got to go from trend to a little bit above trend. And again, what I think is so compelling about the view, if it's correct, is that S&P earnings growth now, in our view, starts to embed some of the AI productivity being delivered to large cap corporate. So I'd still rather make my bones with large cap than I would with small cap.
What about the idea that, okay, we know about the large cap story, know about all the capex and everything else, and then now it's time to really lean into the beneficiaries of all of the AI being put into effect, so to speak, from all of these other companies. And that's where you're going to make your real money in 26.
I think that would be a very tidy outcome for the market. And I do think, again, that is what we are baking into our equation when we say S&P earnings will be up again double digits next year. About 1.5 percentage points of that 12 is it attributable to the full index harvesting those productivity gains. So it's in the doing, of course, but I think that is the nature of the bet we're making when we're so positive on growth.
You sound kind of skeptical to that, though, when you use words like very tidy, in suggesting perhaps that maybe it's a little messier than that.
Yeah, well, I think this gets into some of the local narrative around tech, which is the market's asking more demanding questions around valuation, around financing, around returns, around the growth rate of capex. And so I would say I'm still a believer. You want to be open-minded about where all this leads, but the public market, as it imposes that discipline, is asking these questions, whereas in the 3 years heretofore, Scott, there was just a total simplicity to it, which is this is being funded out of free cash flow, don't overthink it. Nvidia stock's up tenfold in 3 years because its earnings are up tenfold in 3 years. That is simple. I think it's getting a little bit more complex as we move forward.
Okay. I think I know what you're alluding to. I mean, if it's getting more complex because it was funded by free cash flow, you make comments like that, I'm thinking, well, maybe he's alluding to now some of it's being funded by the debt market. And maybe that's making some people a little nervous, and maybe that's the wrong word to use. It clearly is making some people nervous around a select number of names.
Let's think about it just in the context of the Magnificent Seven. 2023, 2024, monolithic freight train, everything firing in the same direction. This year, you've seen a higher degree of dispersion. I think that dispersion will be more of a feature going forward within the tech story, within the AI story.
Okay, so the Mag 7s are not going to trade, I mean, and they really haven't anyway, traded as a monolith. I mean, you look at Amazon's barely done anything this year, whereas other names obviously have had, and most have had pretty good years, but you've already seen dispersion, and you're suggesting that that's just going to continue to be the story as this, arms race, the whole build out just continues to go further.
I think that's right. Again, to be clear, though, within what is still, I think, a bullish context and a positive context writ large, I would say one thing about the Mag 7, which is I do think you start to feel a little bit this year, the weight of the law of large numbers. And so I wrote this down because I couldn't possibly remember it all.
All right,
Scott.
go ahead.
Okay, Mag 7 performance in 2023, up 76%, added 5.1 trillion of market cap. Last year, up 48%, added 5.6 trillion of market cap. This year, up 19%, added 3.2 trillion of market cap. Now, any other country on planet Earth would kill for 3.2 trillion of incremental market cap from some part of its stock market. But all I'm saying is the yards are getting a little bit harder for that trade going forward.
How much Fed risk is in what you're thinking about? Because I mean, I know, obviously the Fed's easier, and the likelihood is that they're going to cut rates at least one time in 26. Is there a lot of Fed risk in how you're thinking about things in the new year? What inflation does, what the job market does, and how they react?
So to level set our view, and I think Jan Hatzius was on with you yesterday.
Yeah.
We think they do go again in March. They do go again in June. That takes you to basically a 3% terminal rate, which is effectively where the bond market is. So I think, again, that is part of, I think, the nice balance that S&P enjoys, cutting into a cyclical upswing. I don't think you can ever divorce the Fed from the equation. And I will try to do this math off the top of my head.
Okay.
But I had put this out in a recent note, which is if you go all the way back to 1997, Greenspan in 1997, where in a way this kind of more proactive policy approach began. If you look at any given year and you just take out the 8 Fed days, and then you take out the 1 day before. So now all you've done is you take 16 days out of a given year, which from 1997 to today is only like 7% of all days. The S&P is not trading at 6,800 something, it's trading at 3,000. It's down 56% from where it is today.
Wow.
So I think you always want to keep a very close eye on the Fed dynamics.
What's the biggest risk in 26, do you think?
I think it is probably the back end of global bond markets. I think it is a reintroduction of this question around debt sustainability. That is not kind of in the fore of the US interest rate market today. But I would keep a close eye on the back end of the Japanese rate market, which has been under a bit of an upward trend, a bit more term premium. My guess is, again, as ever, that kind of washes in and out of market focus. I would imagine at some point next year we're talking about it.
At what point, my last question, I'm going to just play off the words again of yours, responsibly bullish, right? What makes the market get to a place where it's irresponsibly bullish in your mind? What happens? Valuations go crazy in mega caps even. What is it?
Yeah, so my expectation would be we are still too conservative in our estimate for AI capex spending. So again, I'll look at my cheat sheet. Hyperscaler capex spending up 54% last year, up 68% this year. Consensus is up 37% next year. Consensus has consistently underestimated the magnitude of the second derivative of the rate of growth. If we're pushing 68% or 54% next year, I think that would reignite the animal spirits of the market.
All right, we'll leave it there. It's been fun getting your views this year. Tony, I appreciate you spending time with us. I look forward to it next year as well.
Thanks, Scott.
That's Tony Pescarello of Goldman Sachs.
Hey everybody, welcome to Blue Cloud Trading. I'm George. It's the weekend. It's Sunday, December 21st, 9:30 a.m., 9:31 a.m. Eastern Time. I'm 5 hours ahead. I'm currently in Tenerife, Spain, and I thought I would do another video from Friday's episode of the Halftime Report. I wanted to go over a lot of the stocks that they talked about. So that's what we're going to be doing here. We're going to be basically going over the ETFs like the Euro stocks, S&P 500, QQQ, Dow, Russell 2000, the VIX, and then take a look at this. We're going to look at about 11 stocks. I even added Carnival Corporation because that one's popping today. I'm sorry, on Friday it was. And so that's a big move, up 9.81%. And we're going to look at some of those stocks that they talked about, as well as some of the Mac 7 stocks. All right. So let's go ahead and take a look what happened here. At the close on Friday, we had the Dow up 0.38%. You can see it gapped up in the morning, stabilized, dropped a little bit, but it was up 0.38% by the end of the day. The NASDAQ was up 1.31%. Very nice. The S&P 500 was up 0.88%, and the Russell 2000 was up 0.84%. Now, what caused all of this? Well, let's take a look at this here. Tech and AI stocks drive broad rebound as heavy options expirations boost volumes. The NASDAQ 100 jumped 1.3%, led by strong gains in Nvidia, Oracle, and Micron. S&P 500 rose 0.6 to 0.9%, while the Dow added 0.1 to 0.4%, and Russell 2000 climbed 0.8 to 0.9%. Record triple, quadruple witching expirations, okay, pushed the trading volumes over 50% of the average. So if you look over here, there's a little volume bar. It says relative volume. So you can see that's twice the volume, all right? One is typically the average, all right? You can see it's almost like double the volume there on the Dow and the S&P 500. The NASDAQ was about 1.5. All right. Some other things that happened. Carnival surged on record profits and the return of its dividend. We brought that back. And Nike slumped after issuing weak guidance and warning of China-driven sales declines. So with the tariffs, obviously anything that they sell in China now is going to be a lot more expensive. So they're not going to be selling as many shoes there when there's so many cheaper options, I suppose, right? And then no major new economic data released due to government shutdown distortions, it says here. So that's interesting. Because typically there are other economic data, that other types of economic data that was supposed to be released, but they were not released. So that's an interesting factor there. Let's take a look at the heat map here for Friday. And what you'll notice is that, yeah, the semiconductors did pretty well, right? You have Nvidia up 3.93%, Broadcom up 3.18%, AMD up 6.15%, and Micron was up 6.99%. Google was up 1.55%. Meta was down. So was Tesla. Home improvement, like Home Depot, was down, and Lowe's. Berkshire was down 1.76%. The financials looking pretty strong. The capital markets looking strong. Healthcare mostly looking good right there. Industrials looking pretty good. All right, Caterpillar was up 1.84%, but the utility stocks did not do so well, and neither did the consumer defensives, as you can see there. So if we look at the groups, we'll switch it over for a moment here. There's the one-day performance, and you'll see technology, yeah, it was up for the day, for Friday, up 1.96%, and utilities were down 1.08%. But what does a one-week performance look like? So you'll notice that the leader here was basic materials, and consumer cyclical, and healthcare, and financial. Technology was only up 0.1% for the week. So just keep that in mind. Energy down the most, down 2.68%. And we're getting close to the end of the month here. Let's look at the 1 month performance. Basic materials has been the leader, up 9.55%. Utilities, energy, and real estate down the most. You can see those there. Technology for the month, guys, only up 1.14%. Okay, interesting. Let's take a look next. Now, this is my channel, Blue Cloud Trading. If you want to support this channel, folks, hit that subscribe button, hit that notification bell. If you want to get these notifications of when my video pops up, you'll see it pop up in your, next time you're up on YouTube, you'll see it pop up here. You click on the little notification bell and you'll see my video. It's free to do this. If you want to get more content from me, click on this here, the join button. As you can see, I posted another members-only video this week. I do it every weekend. I did one last weekend. I did one this weekend. This one was a 1 hour, 18-minute video. I went over the sectors. I went over what are the strongest industries within those strongest sectors. And then I followed up by looking at the strongest stocks within the strongest industries. So taking a top-down approach, trying to identify the strongest ones. I identified about 25, 26 stocks, and I shared those with Blue Cloud Trader and Blue Cloud Legend level members. So if you want to become a member to view this video along with some of the older videos that you see down below here, okay, what you need to do is right next to the subscribe button, hit that join button. And if you do, what will pop up here is a little box in a second. There it is. And there are 3 different membership levels. You've got Blue Cloud Supporter. Okay, you've got Blue Cloud Trader and Blue Cloud Legend level membership. And something I should note also is that in 2026, the prices will go up at some point. It may be the first month of January. If you want to lock in the prices from 2025, now is the time to do it before the new year. Under Blue Cloud Trader and Blue Cloud Legend level membership, if you guys are already members, just maintain your membership. And you'll keep those prices as long as you'll be grandfathered into this old pricing from 2025. All right, so you can still do that. And for those of you who want to lock into these prices now is the time to do it. So what you would do if you want to access, you can select either Blue Cloud Trader just to watch those videos. But if you want more, Blue Cloud Legend level membership is the next level up. This is where I basically also share daily trade. My daily trades. Okay, I create an update each day in a post, and you'd find that once you become a member, it will next to the posts here, you'll see another tab that will say membership. And if you click on that, you'll be able to see those posts that I place. And thanks for supporting. If you just want to support the channel, you can also just hit the become a Blue Cloud supporter. All right, and that would really help to keep this channel going. All right, let's go ahead, folks. Let's go ahead and get into these. Now we're going to start off with the index ETFs. Now, one of the things I like to do is I like to highlight the strongest either sector or ETF or stock or whatever with a blue flag if it meets specific criteria. What am I looking for? I'm looking for a very strong technical chart on both the weekly and the daily charts. Okay, so FEZ, for example, this is the Euro Stocks 50 ETF. Why is this strong? We're using the Ichimoku cloud. All right, we're using the Ichimoku indicator. Japanese indicator. Ichimoku stands for at a glance. And the idea is, we can quickly assess what the situation here is. You can see that what price needs to be. Let me just show you actually a weekly chart that will clarify it and get rid of some of those lines for a moment. A quick little synopsis of the indicator itself so you understand what we're dealing with here. We've got price right there, those little Japanese candlesticks. Price is 64.62 per share for FEZ. Now, when you throw that Ichimoku indicator on, and all you need to do, for example, if you use this software that I use here called TC2000, you just click on the little plus button up here. You can see all the different indicators below. There's the Ichimoku, for example. All right, you got a lot of indicators. And you can try the software for free with the link. There's a $25 coupon, so you could use I believe it's the basic level to use this software for 1 month. It's not bad. Test it out. But basically, what we want here is price to be above this green line, which is the midpoint of the last 9 periods, not the closing price. Most moving averages take the closing price and they get superimposed. Like this 200-day simple moving average, for example, it looks at the closing price each of the last 200 periods or 200 days in this, or 200 weeks in this case. We're looking at a weekly chart, and it basically plots it. And when you're above that 200, that's very bullish, right? With the Ichimoku, we've got the 9, which is the high, the low, divided by 2, so it's the midpoint of each candle, right? And then it plots it right there. There's Tenkan-sen is what it's called, the Tenkan-sen. Then you got the red line, the Kijun-sen, the 26 period. It's the midpoint of the last 26 periods. It's the slower moving average. We want that green line above the red line. We've got that. What else do we want? Over here, you'll notice there's a white line in the background there. That's the lagging line. It's basically, okay, this week's closing price projected 26 weeks ago, exactly 26 weeks ago. And what we're looking to see is where is that in relation to the candle 26 weeks ago? If it is above the candle, it's very bullish. So we've got that. That's also bullish. Secondly, there's the cloud, and it's comprised of 2 lines. You've got your Senkou span A, the light color blue line, and the Senkou span B, the purple line. How is that plotted? It takes the midpoint here of the moving averages, all right, and projects that 26 periods in the future to get the Senkou span A. And then the Senkou span B is plotted by taking the midpoint of the last 52 periods. But instead of plotting it under the candle like it did in these instances here, it plots it 26 periods into the future, hence creating the cloud itself. So it's all based on mathematical, obviously mathematical equations here. And they're simple, but they are very effective because they help us to identify trends. And so when price, for example, is inside the cloud, we don't have a trend at all, really. When price is above the cloud, that's very bullish. If price is under the cloud, like back here in 2022, bearish. We're under the moving averages, bearish, okay? So FEZ looking great on the weekly chart and on the daily chart as well. You can see the future cloud is bullish here. It's looking good. It gets the flag because both of the time frames have a perfect, all the elements are giving us the thumbs up. What about the S&P 500, the SPY ETF? So looking at the daily chart, you'll notice that price just barely eked out above that 9 period. The Chiku span, however, did not cross back above the candle 26 periods ago. So that is the reason it does not get the blue flag there, okay? The cloud itself is bullish on the daily. Let's look at the weekly chart. So on the weekly chart, you can see we have a very bullish cloud here. All right, Senkou span A above the Senkou span B. And we've got price above the moving averages. Very important. So it looks good on the weekly chart. Let's take a look at the daily. Currently under the Tenkan-sen. That's why another reason why it doesn't get the blue flag. I would hold off on it, even though it does look pretty like it's more than likely to pop here. Confirmation, you'll get that when price gets above these highs of 252.79, for example. And then the VIX, I mean, it was down 11.62% on Friday. That's a really good sign. We want to see that dropping. That's the volatility index. When that's dropping, the market's is typically moving up. So that's really good. That's good to see that. Okay, let's take a look at some of the stocks they talked about on the show. I've already previewed these. Now, just two of them. Actually, they didn't even talk about Carnival. I just added that in there since it was in the news. I thought it'd be, it looked like a pretty cool chart, so I thought I'd share that with you guys. Citigroup. Let's start off with that one. Farmer Jim. I was talking about that. And on the show, Citigroup looking very strong here on the daily chart. This is exactly the type of pattern that you're looking for. Price to be obviously in a nice, strong uptrend, right? And it's very clear. It's above the moving averages. It's above the cloud. You can see the Chiku span is moving up. Volume is increasing down below here. The directional movement index is also looking very bullish. It's when you see the green line moving up and the red line moving down, like you do right here. And the ADX, that represents momentum. So if you see it stalled a little bit, right? And that's what we saw right here. Price stalling right there. Okay, and then popping on Friday on high volume. So Citigroup is a great one. It was up 1.8%. So I like Citigroup. What about Carnival, CCL? Let's take a look at that one. Friday was a big day for Carnival. It popped up 9.81% and it broke through the cloud. So over here, where we could see that we were in a decline. We were in bearish territory for a little bit there. We were in a downward channel. The cloud confirmed that because price was under these moving averages here, right? That all started happening. Basically, it started happening right about this on that candle right there. That could have given you a nice, warning. That's the first warning right there on September 12th that this was going to probably drop and, at least for the short term. And it did. It continued. And every time price tried to recover, like over here, the Kijinsen, the 26 period, the red line that you see right there, held it in place, didn't it? You can see that stalling right there. And then when it dropped under the Tenkan-sen, notice how it stalled right at the green line and then dropped some more. And then when it tried to recover, it created a shooting star right there on that candle and dropped some more. Okay. And then we did break above temporarily, but then we broke right under again. So like it never makes sense to add any new positions when price is obviously in an embedded decline, because it's hard to really determine when that the change is going to take place when that's the case. What we're looking for is that initial break, like this one, above the cloud. Okay, you can also see how the cloud is bearish here. The Senko span A, where it was above the Senko span B, and the purple, the light colored blue line was above the purple. Over here, it had turned bearish, right? And look, we got what's called a Kumo twist, the cloud twist right there. Kumo is for cloud in Japanese. So obviously it's looking pretty bullish here, and you can see the volume that we had on Friday. Let's look at the weekly chart, because we want to confirm that everything looks good on the weekly. And look at this, multiple weeks where price was under the moving averages, and this is the very first week where it's breaking through on high volume. So it gets the nice little blue flag right that it sees there. Everything else that they talked about on the show is not meeting those requirements, okay? Like Bitcoin, BITO, ETF, for example. On the weekly chart, it's under the cloud. On the daily chart, it is also under the cloud. Now, Bitcoin is a little bit different than most stocks, ETFs, and whatnot, in that it's more positioned that a lot of people want to have a very, very, very small percentage of their portfolio in, and just it's more of a buy and hold type scenario. At least it is for me. Like I don't, in my own account, I don't trade this. I just have a position of Bitcoin in a, just almost as like an insurance policy, just in case, right? It's not a bad idea to have a little bit of everything in your portfolio. So like I'm talking about like a 2 to 3% position in BITO, but or not necessarily BITO, but just Bitcoin in general. And right now you can see that it is in fact stalling on the daily chart. So that's a good sign. We can see that price has been stabilizing here. Do you see what I'm talking about right there? Do you see how price came up, came right down to that prior low, and then it's been just kind of building a little bit of a base. I don't know if this is going to continue to the downside or if this is going to be the end of this move, because it is in fact creating a double bottom right here. I don't know if it's going to, we'll know for sure when price gets above that level right there, probably around the 14 or somewhere around that range. Let me see what that price is there. Yeah, 14. So if price gets above 14 on BITO, it's going to be a lot more bullish. But of course, we get all these other resistance levels like the 200-day that's still dropping. The cloud is still very bearish. The Chiku span, as you can see here, is under price, right? All the elements are negative. So I wouldn't be adding positions here. I'd wait for it to like clear this decline. Maybe buy it a little cheaper. You know, if it continues to drop some more. Why? Because look, here's a pretty example of what I'm talking about. You can see over here, for example, it looked like things might, you can see it created a little bit of a double bottom right there, didn't it? So price came down, moved up. Look where it stalled, right at the Kijun, dropped some more. Okay, right around the low, close to that low right there. Maybe it did get a little bit underneath it. But basically, it bounced, found resistance at the cloud and dropped. Came back, found resistance at the 26 period and dropped. Came back, kept on finding resistance on the Tenkan here, right? So it's still in a decline. I don't know. I'd stay out of that one. It just doesn't make any sense to be adding here. Nike down 10.54%. It gapped down. You can see there was no good reason to be holding a position in Nike anyway, because it was in bearish territory, as I mentioned earlier. You know, so Nike is not something I would touch here. Obviously, DraftKings, like, you know, consumer cyclical gambling. They got a sales growth rate of 57.63%, but the price of the stock, if you look at the highs up here, those aren't the all-time highs, but the most, you know, these are back in September of this. Let's see, yeah, September of 2025. It was around 48.99. It's dropped 30%. And in fact, it had dropped even more. It had, at one point, it was down 45%, but it's recovering slightly here. But it's inside the cloud. I'd stay out of that one. Robinhood is also under the cloud. Stay out of that one. We've got a series of lower highs. You can see that here. So there's the high, a lower high there, and another one. We've got ourselves basically a downward channel there. Okay. What about Coinbase? I talked about that one. That's obviously in a decline too. So you see how easy it is. Again, at a glance, we can see where it's going on here. We're in a decline. We stay out of it. We look for strength. We look for stocks that are popping above the cloud, like back here in May. All right, that led to a nice move of about 69% for Coinbase. Maybe a little bit more than that, 70-something% in 2.1 months. Once it got under the Tenkan, it started dropping. Tried to recover here, got above the cloud briefly, and then came back. It doesn't always pan out, but at least you know where you stand with your stocks, right? Or ETFs. Live Nation. Josh Brown is liking Live Nation. I'm not liking Live Nation here. This price is not the right time. This is not the right time to be adding here. A few reasons. One, we're still under that 200-day moving average there. It stalled right there and it dropped. We've got the cloud itself as resistance, but it did break above the Tenkan, and we did get a bullish crossover. The green line did cross above the red line, but again, that can be deceiving. So another thing that positive that I will say is that it did break a trend line. So you can see that high there and that high. If we extend it out further, you can see that it broke through that trend line, and now it is moving up in a small mini flag type situation. But this is more of a bearish, the bearish variant of the flag. It's when you have a, so you can see that right there. These tend to drop. Now, I can't guarantee that. This could be where live starts to recover, but I would not be jumping in here, okay? I'll show you what the bullish variant of the flag looks like right here. So you can see over here, it got above the cloud. Oops, give me 1 second. Right here, so you can see that right there, broke above the cloud area and created a nice long. Okay, there's the flag. Do you see that? Let me zoom in a little bit. There we go. So broke above the cloud, moved up. Okay, you can see it moved up like just like that, and then it created this downward little move, but it found support, and sometimes it finds support inside the cloud. Once it breaks above, right back above, expect it to continue to the upside. That's what we saw for a little bit at least. And that move right there, if we look at the total move, it was about 62% in 5.4 months, and it was about 44% in 2.5 months. Okay, Disney. Let me go to the front over here. Just looking into the past, but Disney company, you can see what's going on under the cloud, stalling right there, stalled over here, and dropped. It's more, I don't know. It just doesn't look very bullish to me. Let's stay out of it, even though it's technically above that 200. Alibaba group holding, also in a downward channel. Okay, so China's getting hit. There we go. You can see that right there. Now this might turn into something bullish. This almost looks like the bullish variant of the flag, but it would have to break through that trend line that you see right there, which it has not done yet. And we've got a bearish cloud right here. Chico span is under price. I'd stay out of that one. AMCR, Amcor, also in a decline. It's under the 200-day. Stay out of that one, folks. All right, very simple, very easy, right? This is nothing complicated. I think we're trying to make things. Remember, trading shouldn't be complicated. You want to minimize the complexity and make it as simple as possible. Look at the fundamentals. Look at the profit margins. Look at the sales growth. If they're looking good, that's great. That adds to your conviction of taking a position in a stock. Don't just look at the technicals. Look at the fundamentals as well. That's why I superimpose the fundamentals up here in the top, so I can have a quick little visual of the health of the company. All right, Mag 7. Let's look at Tesla. So Tesla's got the blue flag right now because on the daily chart, you can see it's above the Tenkan, the Kijun, it's above the Ichimoku cloud. On the daily, the ADX is still moving up, but it wasn't up today. It was down 0.45%. It seems to be just kind of stalling right here, maybe creating almost like a little pennant. They call that a pennant pattern right there. So if it breaks above, that's very bullish. But if we see price breaking under that trend line that you see right there, it could pull back. All right, just keep that in mind. And it looks good on the weekly chart too. Apple pulled back, found some support at the cloud, and bounced. Okay, so I'd stay out of this one for the time being because you can see the negative crossover of the moving averages on the daily. And if you look at the weekly chart, it's still in a very strong uptrend, so that's a good sign. It was looking pretty bearish here in the middle of the week. You can see how that wick again represents the low. That little wick right there represents the low of the week when we're looking at that weekly chart. But it recovered right towards the end of the week, got back above that 9 period, so it can continue on its way. Hopefully, it will continue moving up. We'll see. Meta Platforms on the weekly chart is looking more bearish, but it is holding up above the cloud. So you can see that we still have a series of higher highs and higher lows here. We got a higher high here than the prior one. So you see that right there. And we do have a higher low here from the prior low. So we're in an upward channel, but it's not a very steep move up. It's kind of like a slow move right now, as we can see. Microsoft. Here's the daily chart. So you can see what's going on here on the daily chart with Meta finding resistance, right? Finding resistance at multiple spots. For example, the 200-day dotted yellow line, finding resistance at the cloud itself, got back under there, under the Tenkan as well. So I'd hold off on Meta. Microsoft is also under the cloud, so I wouldn't be adding positions here, but it is finding support at that 200. That's a good sign. I do like the fact that it's finding that support right there, but that's the daily, and if we look at the weekly, we're currently still under the moving averages, but above the cloud. So there's nothing to do here, in my opinion. Amazon is on the weekly chart under the moving averages. Well, we didn't create a higher high here from the prior one. That's good. And we're above the cloud on the weekly. We do need to get above those moving averages. On the daily chart, we're under the cloud. So no on Amazon. Guys, that's going to do it for this video. Thanks for watching. If you guys want to see some of the other stocks, like in the Mag, some of the other Mag 7 stocks, like Google, for example, which is in my portfolio, and I actually talked about it in the members only video. And there's other stocks that whenever they bring up stocks and you don't see them here, it's probably because they're in the portfolio. All right. So yeah, consider becoming a member so you can access those stocks, the analysis of those stocks, as well as get more ideas, for this week. Okay. Have a great rest of the day. I will talk to you all in the next one.